All right. I want to thank everyone for joining us today and welcome you to another Gould Asset Management webinar. Looks like we've got a great live audience joining us for what's sure to be an insightful 45 to 55 minutes. For those of you who may not know me, my name is Scott Smith, and I'm a partner and senior portfolio manager at Gould Asset Management, and I'll be serving as the host for today's discussion and Q&A with Don Gould, our President and Chief Investment Officer. In today's webinar, Don will be reviewing how the economy is performing 6 months into the COVID era, and we'll also discuss the current outlook for financial markets. He'll also provide some thoughts on the possible market implications of the upcoming elections, and then we'll move into a time for Q&A. Some of you have sent in questions in advance that we will be answering during the Q&A. Thank you for those. But don't forget, you can also submit your questions live at any point during the webinar. To do so, just use Zoom's Q&A feature, which you should see at the bottom of your screen. Please post all questions there, as we will not be using the chat functionality to respond to questions. A couple other quick housekeeping items before we get started. First, we are recording today's session, and we will make the replay available shortly after the completion of today's call. So if you have to drop off early or you get disconnected, no need to worry, we've got you covered. Secondly, Don's prepared remarks are expected to last approximately 40 minutes, and then we will move on to a time of Q&A. In the event we don't get to answer your question live on air, we will have a member of the Gould team follow up directly with you in the next day or two to make sure we get all your questions answered. And with that, let's get started and turn it over to Don. Don, take it away.
Thank you, Scott, and welcome everyone. Nice to be here again. So let's get going. Where to begin? If you're human, by this point in 2020, you are fatigued. And you know all the culprits. The pandemic, of course, its economic, social, and health impacts, a national reckoning with systemic racism, now a record-breaking heat wave with wildfires throughout the West Coast, and of course, a looming presidential election. And it's still 3.5 months till New Year's. How could you not be fatigued under these circumstances? So today I'm going to try to give you a break from all that and focus on the economy and financial markets. I'll talk about the headline issues only insofar as I believe they may affect the economy and the markets. So let's start with the economy. It's really a tale of two economies. One economy is doing real well, or at least relatively well. And we'll call this the online economy. It's the economy where people can stay home and still work, shop, eat, and be entertained. It's an economy where companies like Amazon and Netflix thrive. The other economy is doing badly, and we'll call this the in-person economy. It's the economy of close physical proximity, restaurants, airlines, gyms, movie theaters, and so on. The online economy has largely rebounded from the shocks of the spring, and along with it, so has the stock market. In contrast, the in-person economy is in something resembling a depression. The Department of Labor recently reported an unemployment rate overall of 8.4%. That's a bad number, more than double what we were running before the pandemic. But we really think that number is the real number is quite a bit worse. The 8.4% is based on a very selective definition of who is unemployed. In fact, nearly 30 million people, more than 18% of the civilian workforce, are claiming unemployment insurance right now. And in addition, something like 20% of all businesses have permanently shuttered since March. The term that we now see a lot of in the newspaper and in the media is that of the K-shaped economy. One part of the economy, the upward line in the K, our online economy, is recovering well, while the other part, the downward line in the K, our in-person economy, is not. But even in the in-person economy, there are signs of progress. People are slowly but steadily adapting to the new reality. People are venturing out of their homes, wearing masks. In increasing numbers, they're patronizing restaurants, they're getting on airplanes, they're going to the doctor, they're taking vacations. And meanwhile, progress on the vaccine, on therapeutics and testing, all give us some cautious optimism that 2021 will see a trend toward normalcy. Now, probably the top three questions we're getting these days are the following. Number one, what explains a stock market that dropped over a third from mid-February to mid-March and has since recovered to all-time highs in the face of such economic distress? Question number two, what can we say about expected returns going forward? Everyone says the market is overpriced. Is it? Question number three, how might the election affect the stock market? So let's take them in order. Question number one, what explains a stock market that dropped over a third from mid-February to mid-March and has since recovered to all-time highs, particularly when we think about that in-person economy and when we think about those huge unemployment numbers? We see three major factors driving the more than 50% climb since the March lows. Number one, where the stock market is concerned, the online economy dominates and dwarfs the in-person economy. Number two, interest rates have come down significantly since February. And number three, there is a speculative fever gripping a segment of the retail investing public right now. So let's take these one at a time. In the stock market, the relative success of the online economy is completely dominating the effects of weakness in the in-person economy. As we discussed in our last webinar about 3 months ago, the job losses have been concentrated among lower wage jobs in lower profit margin industries and in smaller companies when the size of the company is measured by market capitalization, which is the stock market value of the whole company. Consequently, despite its very challenged condition, the in-person economy has had relatively little impact on the stock market, at least as measured by things like the Dow Jones Index or the S&P 500. The example I used before, and I'll use again, United Airlines, part of the in-person economy, is down nearly 60% since February. And that represents about a $17 billion reduction in the company's market capitalization. Meanwhile, Apple, clearly part of the online economy, is up about 40% since the same point in February. But that 40% represents more than a $570 billion increase in its market capitalization. In other words, even though the one company went south in a big way and the other company went north, the impact on the total market of Apple going up was about 34 times the impact on the market of United going down. So that's number one. Number two, interest rates have come down significantly since February. The Fed has cut short-term interest rates. It has also said that it will wait longer to raise interest rates should inflation rise above its long-term target. Net, we and most observers expect interest rates to stay very low for years to come. Now, to be specific, the 3-month Treasury bill has dropped from 1.5% yield at the start of the year to 0.1%, meaning cash, as it did for several years following the 2007-2009 crisis, again yields nothing. Long-term interest rates have also come way down, and the Fed has played a role there too. The 10-year Treasury yield started the year at 2%. Currently, it's under 0.7%. Now, other things being equal, lower interest rates push up the price of stocks and bonds and just about every other asset class. Now, to understand why this is so, I think a good example is to consider a 10-year Treasury bond that was issued at the start of this year when the interest rate was 2%. The buyer who invested $100,000 in that bond will get $2,000 per year in interest every year for the next 10 years. But today, for that same $100,000, a new investor in a new 10-year Treasury is only going to get $700 a year in interest for the next 10 years. So on the one hand, we have one bond paying $2,000 a year, another bond paying $700 a year. Clearly, you would pay more for the old bond and its $2,000 per year income stream than you would pay for one that's only going to give you $700 per year. So the old bond now sells for much more than the $100,000 that it was originally bought for. Stocks are like bonds in that both are expected to deliver a stream of cash flows into the future. In the case of stocks, it's through a combination of dividends and capital appreciation. So just as lower interest rates make existing bonds more valuable, they also push up the price of stocks, other things being equal. Okay, let's now talk about the speculative fever. We're seeing a retail speculative fever for stocks, unlike anything we've seen since the dot-com days of the late 1990s. For Exhibit A, I'm going to share my screen here and show you a chart of Tesla, the electric car manufacturer. All right, here's Tesla. Now you can see that over the last, how many months? 9 months or so, this stock has gone up more than 4 times. And yes, Elon Musk is a genius, albeit an erratic one. And yes, the cars are great, at least if you ask their owners. Yes, the company is profitable barely, if you believe the accounting. Yes, they have a battery business on the side that holds potential. But at this price and at a market capitalization of over $400 billion, the company is valued at over $1 million for every car sold annually. The price earnings ratio is over 1,000. So the question we have to ask ourselves is, whatever we think of this company, what is it that would make the company 4 or 5 times more valuable today than it was at the beginning of the year? So we think this is an example of speculative excess. Exhibit 2 is options volumes. I love this little illustration here from an article yesterday in the Wall Street Journal, which I'm going to talk about in a moment, but it's got the bull and the bear in a rowboat on a giant wave of cash. And so let's talk about options. A call option is a way to bet on a stock without requiring nearly as much money as you would need in order to actually buy the stock itself. It's a short-term, highly amplified bet. If the stock goes up far enough and fast enough, you can make a lot of money in a hurry. But if the stock doesn't go up, or if it does go up, but it doesn't go up soon enough, you can lose your whole investment. Point being, buying options to make short-term bets on stocks is a highly speculative activity. This story that I was referring to in yesterday's Wall Street Journal notes that the volume of trading in options on individual stocks now exceeds the volume of trading on the underlying stocks themselves. And so this chart is taken from that article in the Wall Street Journal. You can see that going back to 2005, which is where the chart begins, up to, let's say, 2019, options volume as a percentage of underlying stock trading volume ranged from maybe 20 to 50% most of the time. This point here is October 31 of this, sorry, March 31 of 2020. And you can see that from this point, March 31, less than 6 months later, option volume is now over 120% of the underlying stock trading volume. We think this is, again, a perfect example that there is a huge speculative fever going on out there. Then the question might be, well, why this fever now? One second. And I think, there's a number of potential ways to think about this. The first would be that sometimes these things happen. People get carried away from time to time. Just as people sometimes get very pessimistic, sometimes they get very optimistic, even euphoric. And there's not necessarily any good explanation for it. But I do think there are some potential explanations that relate to the lockdowns. We have more people working from home. We have more people who have time on their hands. And I think that may be contributing to it. We have fewer other things to entertain us. Sports obviously is coming back, but it's still not where it was. And we also have some structural things going on. We have the elimination of commissions, brokerage commissions late last year. Pretty much all the brokerage firms did away with commissions. And we have these smartphones that we all walk around with all day. And now you can trade stocks or options from your smartphone wherever you are at any time of day. So I think all of these things have contributed. Now I want to make an important point here. Assuming that I'm correct and we are witnessing speculative fever, it still tells us nothing about where stocks are going next. These things, these fevers, can and often do go on for much longer than you would expect. The main lesson is not to get caught up in the frenzy yourself. When these bubbles pop, and eventually they always do, it's sudden, it's ugly, particularly for those who got carried away. Okay, let's move on to the second question. What can we say about the expected return going forward? Everybody says the market's overpriced. Is it? I'm going to take a little different approach to answering this question. I'm going to center my answer around one economic indicator that I think everyone should keep an eye on, but relatively few do. That number is the interest rate on the 10-year U.S. Treasury inflation protected security, better known as the 10-year TIP. So first, what is a TIP? A TIP is a special kind of bond where the principal amount of the bond is adjusted each month by the change in the consumer price index. In other words, as prices rise, the principal amount of the bond is increased by the percentage increase in the CPI. In other words, the principal moves up with inflation. And since the dollar value of the principal is going up with inflation, the interest payment is also going up with inflation. Let's take a numerical example here. Let's say you put $100,000 into a 10-year TIP having a fixed interest rate of 1%. At the start, your bond has a principal value of $100,000 and you are receiving $1,000 of interest per year. Now, suppose we have a 2% inflation rate in the first year of that bond's life. Then at the end of that year, your bond principal will have been adjusted upward to $102,000. You're now receiving 1% of that higher number, which is $1,020 per year. But whether inflation was 0 or 2% or 10%, in our example, no matter what inflation was, and no matter what it turns out to be over the next 10 years, our investor will return 1% per year above inflation. And that's why they're called inflation-protected securities. Any return that an investor earns above inflation is known as the real return. It's called the real return because it measures the increase in the purchasing power of the asset, as opposed to simply the price of the asset. We focus on real returns because the point of saving and investing at the end of the day is to eventually convert those savings into consumption. Eventually, we're going to spend it in retirement, or maybe it's a college savings fund. But either way, we want the purchasing power of our portfolio to at least be maintained over time and ideally grow. In other words, we want a positive real return. So I think there's at least 4 reasons why the TIPS yield is a uniquely important and interesting indicator. And I'm going to bring up a chart here in a second. Okay, here we go. Have I been sharing my screen all this time? Okay, let's see. One second, please. All right, here we go. Okay. So what we have here is the TIPS rate going back to the year 2000. And you can see that it started actually up above 4%. These were a wonderful investment in the year 2000. You could lock in a 4% real return for up to 30 years, US government backed. But you can see they've steadily come down over time. And recently they've actually fallen below 0, which, you know, is a sobering point. But I said there were 4 reasons that I think the TIPS yield is uniquely important. And one of them is that it tells us what long-term real return investors will receive from the safest possible asset. And so you can think of this yield that we're seeing here as kind of the floor, the bedrock on which expectations for the returns on riskier assets are going to be built. Now, historically, stocks have returned about 5% per year above government bonds. And if that relationship holds over the next 10 years, then stocks would average about 4% real, or a total return of maybe 6% per year, assuming an inflation rate of 2%. Now, since 1927, government bonds have returned about 2% per year above inflation. But this chart shows us that right now, over the next 10 years, we're not even going to keep up with inflation in a government bond. And stocks have averaged about 7% above inflation. So I think the key point we want to take away from this is that the TIPS yield is telling us that we need to be prepared for lower returns on both stocks and bonds in the future than what markets have delivered in the past. The implications of this, first, if you are in the accumulation phase, still working toward retirement and building your nest egg, this could mean that you would need to work longer, or you would need to save more, or some combination of the two. If you're already retired, in general, the impact is less. And the reason for that is that while lower expected returns might reduce the percentage of your portfolio that you could sustainably spend each year, your portfolio has been pushed up in value by the decline in interest rates. Okay, the second thing is that the TIPS yield tells us what people think about the economy. It's, if you have a low TIPS yield, what that in essence is saying is that the demand for money is low. And in turn, that means that businesses in general do not see opportunities for big returns on investment, whether that's investment in marketing, research and development, plant and equipment. Now, this is a generalization, but again, if we're looking for one statistic that tells us big picture what people are thinking about the economy, this statistic here, this number would tell you not very bullish. The third thing that TIPS yield tells us about is what people expect about inflation. If you look at the differential between the yield on regular treasuries and on tips, we can infer what the market expects inflation to be. Investors will be indifferent between a tip and a regular treasury bond. That is to say, we will have reached a market equilibrium when the yield difference between the two bonds equals the market's inflation expectation. So to unpack that statement, if we look at this chart here, we have this brown line, which is the yield since the beginning of the year on the 10-year treasury, and the blue line, which is the yield on the 10-year tip. And if we look at the spread between the two, what we can infer from that is the market consensus expectation for inflation going forward. Now you'll note that we started the year with about a 2% inflation expectation over the coming 10 years. But at the height of fear in February and March, you can see that the spread narrowed quite dramatically. And that, I think, is indicative that there was extreme pessimism at that time about the economy. If the economy gets slow enough, inflation, other things being equal, goes down. But you can see that since then, the spread has basically returned to about where it started the year, except that the absolute levels of the yields are both down about 100 basis points, 1 percentage point. So compared to where we were a year ago, or at least 9 months ago, the TIPS yield is telling us to expect slower growth, but about the same rate of inflation. Okay, now finally, the TIPS yield may give us some idea of how much reward we can expect to receive for taking risk, the risk of being in the stock market. And that in turn might tell us something about the odds of a bear market. And this gets to the question of, is the market really overpriced? So here's one way that we look at it. Here what we're looking at on this jagged line is the differential between the earnings yield on stocks and the yield on tips. And this goes all the way back to 1940, so it's quite a long-term chart. Each of these little square brown boxes represent a point in time where a bear market commenced. That's a decline in the stock market of at least 20% from its peak. A higher spread between the earnings yield on stocks and the real interest rate would suggest that we're being rewarded more for taking stock market risk. And a smaller spread would suggest we're being rewarded less. So what you see here in essence is that the way we've inverted the axis here, the higher points on this chart, like these here, represent a point where the stock market is more expensive. And points below the horizontal line represent points where the stock market is less expensive, at least, than its historical average. We might think that bear markets are more likely to begin when the market is expensive, when we are getting relatively little reward for taking stock market risk. And in fact, most of the brown boxes in this chart have occurred above the horizontal line here. But I will quickly point out that several occurred, including the most recent bear market, from a point where stocks appeared to be somewhat cheap compared to their historical average. Now, this one obviously was triggered by COVID. Economists would call that an exogenous shock. Nothing to do with the business cycle, something that comes out of left field. And that can always happen. But what's, I think, very interesting about this chart is if you look here you can see that even though the market has gone way up over the last 6 months, it appears the market has actually gotten a little bit cheaper. And the reason that's the case is that the real interest rate, our trustee TIPS yield, has actually fallen in relative terms faster than the market has gone up. And so I guess the key point from all of this is that despite everything, including record high index levels, the speculative frenzy that we talked about, and the, just everything else that's going on right now, the probability of a bear market right now is not elevated. At least it doesn't appear to be. If anything, it's below average. Now, I want to hasten to add and be very clear on this point. We are not saying that there won't be another bear market soon. We don't know. What we are saying is that based on this indicator, the odds of a bear market do not appear to be elevated right now. Okay, question number 3. How might the election affect the stock market? Well, we're going to try to keep this as simple as we can. And so for the sake of simplicity, let's think about 4 possible outcomes. Outcome number 1, a clear victory for Biden, and the Democrats control both the House and the Senate. Outcome number 2, a clear victory for Biden, but the Democrats do not win both the House and the Senate. And most likely in that case, it's the Senate that they would not win. Outcome number 3, a clear victory for Trump. Outcome number 4 would be what we're calling a contested election. Contested election is one where the outcome is not clear. The market is anticipating volatility around the time of the election. How do we know that? We can infer this from the price of an option. The same kinds of options that we were talking about a few minutes ago, the call options or put options. We can infer this because options expiring around the time of the election are comparatively much more expensive than options expiring either a month before or a month after the election. This suggests that markets are assigning a meaningful probability to a contested election. And that could mean a lot of things. It could mean court battles, it could mean street battles, it could mean a constitutional crisis. Our view is that the stock market can live with either candidate, at least in the near term. If we have the first outcome, a Democratic clean sweep as it's called, we could expect higher income taxes, higher capital gains taxes, higher payroll taxes, but specifically in all 3 cases applying to the highest income households, those earning more than $400,000 a year. We could probably expect higher corporate tax rates, a rollback, partial or complete, of the 2017 corporate tax cut. We should expect to see higher estate taxes on the highest net worth households, those with net worth in excess of $12 million. We should expect to see a more stringent regulatory environment. And I think all of these things taken by themselves would likely be viewed as a negative for the stock market. But I think moderating that is a couple things. The first is that Biden himself is, relatively speaking, a centrist within the Democratic Party. I think too, in the Senate, Democrats run the gamut from very liberal to right of center. And I think for both of those reasons, any changes in tax policy are likely to be the result of a compromise and will probably not be extreme. Let's go to the second outcome. If Biden wins, but say the Democrats do not take control of the Senate, I would expect on taxes, the status quo would stay in place. Similarly, if Trump wins, status quo on taxes. But there are clearly other considerations for the market beyond taxes. And just to name three: trade policy, foreign policy and international relations, immigration policy. The list goes on and on. I think there's a tendency to focus on taxes to the exclusion of the whole range of things that could affect the market going forward. There's probably more near-term market risk in the event of outcome number four, a contested election, than in the case of a clear victory by either candidate. We could have an extended period of time during which the election outcome is not determined. But at the end of the day, we're still talking about either Trump or Biden as president. And if we look historically, there's really not much correlation between the performance of the stock market and the party of the person in the White House. So I guess the bottom line is there may be plenty of reasons to lose sleep over this election, but we don't think that the stock market should be at the top of that list. All right, well, that concludes my remarks. And Scott, let's move into the Q&A.
Sounds good. Thank you, Don. Very insightful. Just a reminder, everybody, we're going to now move into the Q&A portion of our webinar. And if you'd like to submit a question, use Zoom's Q&A feature, which can be found sort of at the bottom of the video. There's a little icon there that says Q&A. I would encourage you, if you submitted a question, I saw a question earlier in the call. I had a technical issue and hopped off. I don't see any questions in the Q&A, so I would very much encourage you, if you submitted a question earlier, to please resubmit that question. Looks like we might be having a little bit of a technical issue there. Don, I don't know if you can see live questions there, but I don't see any yet. So, and I know there was one earlier, so I would encourage people to resubmit those if you did already put one in. We'll start off, though, with some questions that were emailed into us over the past week. And the first one, let me pull it up here. Says, how is Gould using the climate change science and projections strategically to shape its investment decisions? Is Gould deciding to avoid investing in companies that have poor environmental records?
Okay. The answer to that is that we really give the client the choice of whether they want to take a neutral approach to what we might call environmental, social, and governance factors in investing, or whether they want to take a more active approach to try to incorporate those factors into security selection. And so we have an increasing number of clients who do want to be more active in those kinds of decisions. And we have a number of ways to incorporate that into portfolio construction. It's certainly the case that having an environmental focus on security selection, especially stock selection, has helped underweight or avoid investments in fossil fuel producers over the last 5 or 6 years, which has certainly helped performance significantly. And there is a lot of evidence that the social and the governance factors as well could contribute to return over time. But again, we leave that ultimate decision up to the client.
Great. And kind of as a follow-up to that question, Don, we have another one that says, in light of the pandemic, social unrest, political polarization, and global warming, what should we be thinking about as individuals as we do our individual financial planning?
Well, that's a lot. Start with a glass of white wine. And then I guess what I would say, reading a little bit between the lines of that question, maybe what the person is asking is, do all of these scary things mean my portfolio is going to do badly? Our answer is we don't think so. But obviously the future's unknown. I think it does kind of highlight in some sense the limits of money. Money can do a lot of things for us. It can give us a bigger, more comfortable home, a nicer car, possibly enable us to send our kids to a better school. But there are many things money can't do. I mean, right now, no amount of money is going to clean up the air on the West Coast. And so I think it's worth remembering that, you know, there are limits to what our portfolios can do for us. But I think the point I would leave you with is that despite everything that's going on and despite how serious and scary it all is, I think the most important thing in terms of financial planning is not to let it distract you to the point where you lose your focus and you divert from your long-term, well-established financial plan.
Great. Switching gears a little bit, Don, we have a question about real estate. Question says, in many areas of the country, residential real estate is performing like gangbusters. What information have you seen concerning commercial properties? I suspect that this segment will be challenged with all the companies going out of business in the big box space.
Okay. Certainly commercial real estate, which I define as office space, is very challenged because people are working from home. It's not clear if or when they're going back. It's probably also the case that even if COVID is no longer a concern, there will be fewer people commuting into an office than was the case in the past. Given all that, commercial real estate is going to be very challenged. Retail has a different, perhaps more temporary challenge to it. Retail arguably is what we were talking about when we said the in-person economy. I think in time, the in-person economy is going to come back and probably come back all the way. Perhaps not as much for the airlines because business people have figured out that they don't need to fly as much to have meetings. But in general, I think that will come back. But both commercial and retail are quite challenged right now. Of course, that doesn't mean that their price doesn't already reflect that challenge. So you have to be careful not to confuse the fact that office buildings might be half empty with whether or not they're a good investment. Certainly their price has been marked way down in the last 6 months.
Don, moving over to some of the live questions we've received. I see one here that we get pretty frequently, so I'm going to throw it out to you. It says, with government incurring more and more debt, how is this going to impact Social Security's solvency? How long do you think we can rely on it?
Well, you know, Social Security obligations are denominated in dollars. And the US government has the sole right of printing dollars. And we've seen the government print a tremendous number of dollars in the last few months as part of sort of the economic bailout. So if the question is, might I not receive my Social Security check in the future? The answer is no, you will receive your check. The real question is, will the amount keep up with inflation? Will the rules change? Will it be taxable? Will the age at which it begins be extended outward as life expectancies increase? So, you know, it kind of goes back to our discussion of real returns. What will be the real value of your Social Security? If you're in your mid-60s now, I think you're probably okay. There's a tremendously strong political bloc, you know, for protecting Social Security benefits. If you're 33 years old, I think there's a real question mark as to what your Social Security will buy 30, 40 years from now. But will you get it? Yes, I think you'll get it.
All right, next question asks, do you see the same outlook for overseas investing as you see for domestic investing?
You know, most of the people that we read feel that international markets are more attractively priced than the US market. But I would add that they felt this way for many years. And the US market has continued to outperform foreign markets. On the other hand, if you look at the really long-term scope of history, you see that over the long haul, the domestic and the international markets tend to perform similarly. It's just that they take turns leading the pack. And so our philosophy is we can't really time it. We don't know when international is going to shine as compared to domestic. We maintain a permanent allocation to international developed and emerging markets for that reason. And if one market, let's say the US market, substantially outperforms international, we will be rebalancing back to keep the ratios of domestic to international where we want them.
Great. Next question is on Tesla, Don. In regards to your comments about Tesla, do you just avoid trying to play the overvaluation? I think they're asking if we should be, or they should be, dabbling in Tesla.
Yeah. I think that the answer is what you cannot do is a short sale. Okay. A short sale is where you're betting on the stock going down. But the problem is that if the stock keeps going up, you can lose a lot of money. And there's theoretically no limit to how high the stock could go, particularly if its price has become completely unmoored from any kind of fundamental analysis. So I think the short answer is probably the best you can do is just avoid it. Stay out of the way. Watch it for entertainment value. Of course, you can use options, which at least limit how much you can lose. Of course, the joke is you can lose 100% of what you invest in the options, but you can't lose more than 100%. And you could make a relatively small investment in the options. But my advice would be to just stay away.
I think that's good advice. All right, I think we're trying to keep this under 50 minutes, so we'll make this the last question. Given low interest rates and a low chance or lower chance of a bear market, do higher yielding dividend stocks in stable companies make sense as a good investment?
Our approach to the stock market is, first of all, that we don't do individual stock picking in general. We rely very heavily on market cap weighted index funds. And those index funds own everything, right? They own stocks that pay no dividends at all, which includes some of the high flyers, like an Amazon. They include stocks like Verizon that would pay a very high dividend yield. But we don't pick the stocks on the basis of the dividend yield. We do have an investment strategy that does focus on dividend yield, but in general, our core strategies don't distinguish between whether the company is paying a dividend or not. We're focused on total return. Total return is the sum of the dividend plus any capital appreciation. I don't think that the fact that we have low interest rates and maybe a less, a non-elevated risk of bear market, to me, that does not say that one should be moving toward high dividend stocks. I think what's implied there as well, if I'm trying to get income, I could get income from the dividends. It's true, but in general, we think that's the tail wagging the dog. By that argument, you would buy the highest dividend yielding stocks you could, but the problem is that if the total return on those stocks is less than, say, the market as a whole, in the end, you have less money. You have more income, and by the way, you're also paying more taxes because dividends are taxable currently, whereas a capital appreciation is only taxable when you sell the asset. So I think the short answer to that long answer is no.
All right, great. Well, there were a few questions we weren't able to get to. Like I said earlier, We will be sure to follow up with you individually and make sure we get those answered. We thank everyone for joining us today. We will continue to hold webinars going forward. We've gotten a lot of positive feedback from clients. This is a great value add. And so keep your eyes on your inboxes for our next webinar. And Don, unless you have anything else to add, I think that's it.
Stay safe and have as good a rest of 2020 as is possible.
Yep. Thanks, everybody. Have a great day.
Thank you.